Hey guys, John Paulamy here, Actionable Intelligence. Today is Saturday, January 14th, and this is the weekly market update. Before we get started, a couple of things I wanted to mention. We're close to 10,000 subscribers to the YouTube channel. I think we're 37 away. If you enjoy these videos, if you're getting some use out of them, do me a favor and subscribe, comment, hit the like button. It helps us out. If you understand and are interested in the actual actionable themes and how I invest in these and how I speculate in these, we have the Actionable Intelligence Alert newsletter. It's available. It's a monthly, comes out monthly. We have the Discord channel where many of the subscribers participate, talk about a lot of things. This is available to you also if you're inclined to support us. The subscription terms and link is in the show notes below. And so if you're inclined, feel free to support us in that manner. All right, let's get started. The disclaimer, anything that you hear or see in this podcast or video is not to be taken as investment advice. I'm not a registered financial advisor. I cannot give you personal financial advice. This is for informational purposes only. We ask that you do your own due diligence on these ideas, and it's your money, it's your responsibility. Okay, so one of the major themes that I've had for 2023 was the eventual return of China to the oil market. Obviously, you all know that most analysts thought that China would slowly but surely, end the COVID lockdowns and the policy would change over time. They instead decided just to rip the Band-Aid off. And so I think that I'll show in some subsequent slides, we're already seeing a return to normal, close to normal, and how that's going to affect commodity markets. We're seeing that in the markets. We have copper over $4 a pound. We've had oil prices up like the last 5 days or so. Anyway, this is an article that I'll put a link to in the Substack, this chart kind of showing the consensus views or the views of various agencies, energy agencies, and OPEC about demand for 2023. They were all saying that, we're over 100 million barrels a day, and we'll be heading higher as we get into Q2. That's kind of been my view also. I've been saying that. I think that I don't know how high we'll get this year. You have anywhere from 101 million barrels a day up to over 103 million barrels a day. The point being that because of the lack of investment and other things, which we've talked about ad nauseum, I'm not sure that the price is going to stay where it's at if we go to a demand of 103 million barrels a day. So I wanted to post this as Chinese demand returns, as the SPR starts to end, is that going to be 3-4 million barrels of returning demand or of oil that has to come from somewhere? So we'll see. I don't know the forecasting record of these entities, but I just wanted to put this out here for food for thought because this is kind of consistent with what we were thinking about too. We've been talking about this, and it's just interesting to note. Sometimes, when it's consistent like this, we have to weigh into the fact that the possibility of a recession in the United States, obviously in Europe. So these things will have to balance, but we'll see how it goes. Eventually, though, the long-term thesis of the lack of investment is going to come back and bite us. I'm not sure the world has the capability currently to supply 103 million barrels a day without a major price increase. Well, we shall see. Again, we've talked about Chinese demand. This is off a tweet. And basically what you have here is major urban hubs see record surge in congestion, this car traffic congestion on traffic. You see overall, you just see like since they ripped the Band-Aid off, pretty much across the board in all these cities, you're seeing a major V-shaped turnaround. Down here, you see another note. Road traffic in China in the week ending January 11th was up 32 percentage points to 134. I guess this is the basis of the uh, whatever starting point they're at that they're measuring from. But you can see pretty consistently the V-shaped recovery in all the cities. And if you just want to look at, I think the China 15 is the top 15, basically cities here in an average. So this is indicative of a V-shaped bounce, positive and consistent with our projections. Here's the chart I showed before on flight data in China. You can see they just started posting on this chart the 2023 data. You can see the end of 2022. We were already recovering from early December. We had a little dip, but you can see that we're pretty much going up at like a 60-degree angle, like a missile shot here. So I think at the low here in early December, we were around 3,200, 3,500 flights a day internally in China. We're well over 10,000 now and continuing higher. We're getting close to levels of being normal. I think international flights will be starting soon. So this is, again, I've actually heard some analysts say that they don't really see this being a big deal, but I don't understand why Chinese consumers would be any different than consumers around the world. I mean, Chinese folks were locked down for 3 years. When people emerged from lockdown in North America and Europe, they kind of went nuts on going on trips, resuming their life, spending money. They had been cooped up. And I think something similar, I think I saw a projection that like over $1 trillion in spending power has been accumulated by Chinese folks during the lockdowns. I mean, you just see this anecdotal data around, travel plans and inquiries into travel is up hundreds of percent. You have an earlier start this year to the Chinese New Year. So we'll see what happens, where this thing peaks out at and levels off at. Maybe it's just a spike during the Chinese New Year travel. We'll see. But you really don't see anything in the news anymore about, when they originally ripped the Band-Aid off, there was all of these Armageddon scenarios and people taking pictures at crematoria where body bags were lined up and millions of Chinese are going to die. I don't see the Chinese reversing this policy. That would really have to really be something major. And I just don't see the news items. There was an initial, attempt by the media to create a, panic narrative, but I think that's went away and people are traveling and it's not the end of the world, just like it wasn't anywhere else. So obviously people do die of the flu. They do die of COVID. They do die of respiratory distress. It's unfortunate. People die every day in car accidents and every other method, but it's not the end of the world. It's just life. Life goes on. And so I think, as I've said before, I don't believe Chinese consumers are any different than any other consumers, and we should expect to see this return to normalcy, and that requires more energy. That's the thesis, right? We'll see what happens. Like I said before, you have copper over 4. You have a lot of speculations now. You have oil kind of looks like it's bottom, possibly, and has been up to like the last 4 or 5 days. We'll see. That doesn't mean we go directly to $150 a barrel, but a lot of the companies in the portfolio have paid down their debt over the last couple years and cash flow tremendously at $85 Brent. Again, I think last week we had a major discussion around uranium, remained very positive on it. I like to highlight these news items, not because individually they matter in the big scheme of things, but collectively the inertia continues to build. South Korea to boost nuclear and downgrade renewables. Very positive news from South Korea today. Quote from the article, South Korea will boost nuclear power generation and downgrade its plans for renewable energy as the nation overhauls its electricity mix to meet emissions reduction targets, unquote. So there you have it. I mean, I think that, like I said, we've reached peak ESG. I made a video about that several weeks ago or a couple months ago. You're seeing the realization after the initial burst of excitement and government support. Reality is creeping into things. It's becoming obvious, at least to people that want to have a rational energy policy that they can't do this with wind and solar. And so nuclear is getting more and more traction, becoming more and more of this part of the discussion. And like I've said before, it doesn't matter if you're, European or in these states, you have to think globally. When you're talking about these energy mixes, you can't just think about have home country bias. Well, we haven't built a new, reactors, or we're closing reactors in Europe. What are you talking about? You have to look overall, because the real growth in this is happening in the global South and the global East. Again, here's Saudi Arabia plans to use domestic uranium for entire nuclear fuel cycle. Saudi Arabia's energy minister said on Wednesday the kingdom intended to use its domestic uranium for the entire nuclear fuel cycle, which it doesn't have right now, by the way. It's going to build it, evidently. He added that the recent exploration had shown a diverse portfolio of uranium in the country. I do not know how large that is. I'd have to go check that out. Evidently, it's pretty high. But I thought this was interesting. He told a mining industry conference in Riyadh that this would involve the entire nuclear fuel cycle, which involves the production of yellow cake, low enriched uranium, and the manufacturing of nuclear fuel, both for our national use and, of course, for export. So, new shooter at the table. I don't know what their resources are and how long it would take them to develop. I think in the article it said something like by 2030. So, again, individually, these things don't necessarily mean anything, but collectively, you see what's going on. It's perfect. Nuclear is perfect for a place like the Middle East, because why? Not only do you get the electricity, and then you can cut down the oil and gas burn for your electricity generation, but just the tremendous amount of waste heat that's generated by these reactors can be used for things like desalination plants and things of this nature. So um, there's other value adds besides just making electricity. But again, this is another brick in the wall of the positive view that we have towards nuclear power. The uranium stocks have not performed well, especially from a lot of the back end of 2022. I think a lot of interest is going to come back again. I think, I've said this before, we're at the closer to the end of the tightening liquidity that we've experienced over the last year or so. And space like uranium is a very small market cap. It's a risk on type situation. You have a lot of speculation going on, especially with other junior miners that don't produce anything. And I think that as liquidity returns, which it will, the Chinese have already started a new liquidity cycle, impulse, injecting like $250 billion into their economy just in December. But I think you're closer to the end of the tightening cycle in the world than I think you are at the beginning. And as economies slow down, central banks will do what they always do. They will create liquidity by QE and lowering rates, and then you'll see money come back into these risk assets, like more speculative areas of the market, like uranium mining. Notwithstanding the fact that the fundamentals are continuously still positive, you really haven't had the big institutional push into uranium mining. I think that's coming, especially as a cover for the ESG, but you can only get so much money in this market. It's not that big of a market cap. I think at the last uranium cycle, the market cap for the industry was like 150 billion, maybe. That's nothing in the overall scheme of things. There's many, many companies in the S&P that have market caps bigger than 150 billion. So this is something I wanted to point out. This is the MSCI Emerging Markets Index. It's up more than 20% since the low in October. I'm just showing the last year. I wouldn't necessarily bet the farm on this, but do we have a turn that looks like a breakout from the downtrend? Why do I bring this up? Well, I think I've shown this chart before. This is a chart that shows the difference between the MSCI emerging markets and the MSCI world, basically emerging markets versus developed markets. Obviously, the world index is dominated by the developed markets. And what I think you would note here is that you have these cycles, it seems to be, where emerging markets outperform developed markets. And it seems to go in 8 to 10 year cycles, as you can see, from like 88 to 94. That was like a 6-year cycle. Then you had this pullback, bottomed. then 2001 to 2010, then it topped out. Emerging markets have been in a downtrend since then for 12 years. And I think this kind of correlates with like commodity cycles a little bit. Why a lot of your emerging markets, like we just talked about it, are commodity producers. And so I think if you're in a commodity upcycle or a period where commodities are strengthened pricing, then you have a tendency for these emerging markets to outperform. So I'm not saying that we have a definitive turn here, but I would say this is very interesting in the context of looking at this chart, that have we bottomed, and 20% in a market is considered a bull market. So this is emerging markets. You can look at charts like of Mexico just recently, the ETF there broke out. I haven't went through all of the emerging markets, but I am noticing more interest in these markets as obviously the dollar has weakened recently. So there's a lot of intermarket relationships involved here, but I think that we may be on the cusp of a move higher in emerging markets relative to developed markets performance. And I thought this was interesting. I think I did show this chart before, but predicting these things, again, you don't exactly hit the bottom or the top on these things. And so, if you look at the previous cycles, is there something that, would correlate? And I think it's, like I said, the correlation or the influence of strengthening commodity prices on emerging market economies. So I wanted to talk about gold. I got some emails and some messages about gold, and my stance on gold is the same. This is what happens, right, guys, with a lot of retail investors. Gold's been up since October. Look at, you can see this is a weekly chart, so there's only been like 1 or 2 down weeks in the last couple months. And so people are attracted to it now. It's the new shiny lure that went in front of, the people's eyes, so they're following it now. But I caution you, I have a small position, as I mentioned, like a couple months ago, in some junior miners as a speculation, because I thought that, these things had been broken down so much. And I think my feeling was that, again, that we're closer to the end of the liquidity cycle, tightening cycle, than we are the beginning. And so I think when liquidity returns, this type of risk asset will outperform. I had talked about Bitcoin miners before on the channel, not just in general. Those have really outperformed recently. Bitcoin has kind of come off its bottom, its recent lows. Miners, some of the miners are up, 80, 100%. Some of the gold juniors are up 80, 100% or more. But am I ready to go hog wild? No. What I want to see is what happens with, again, these are risk on liquidity fueled markets, speculative markets. And so what I want to see is what's going to happen in February. Are we going to have another 50 basis points? Are we going to have 25 basis points? You see inflation coming down. You see the economic indicators. Now you have ISM and PMIs under 50 now, which indicates contraction in manufacturing here in the U.S. So at some point, there's a lot of, I'm amazed listening to these Twitter spaces with guys that run billions of dollars, millions of dollars of money, and they'll just talk for hours about, well, the Fed's really committed this time. I mean, this is another Lucy. I mean, this time last year, relative, like in December of last year, or of 2022 or 21, I mean, we were at 0.25 on the Fed funds rate, and they weren't even talking about, and they were saying inflation was transitory. And so a year later, I'm supposed to, and this is the way we always do. We have this like short-term view of this thing. So I don't get too caught up in this. I know that the Federal Reserve and central banks exist for one thing. They are inflation creators. They create inflation. Okay, that's what they exist to do. They are controlled by the banks. Jerome Powell comes from the financial sector, and he's trying to do this balancing act. And it's going to be interesting to see when the economy starts coming undone, and will they be able to get rates down, inflation down to 2% before they have to reverse course and start reliquefying the financial markets. We'll see. But I think, that's partially why you're seeing some of these risk assets come back. They're kind of forward looking, right? Nothing trades on previous information. You don't trade on the rear view mirror. You trade on what's going to happen on in 6 months or so, 8 months, a year. That's what traders look at. They're not looking at what happened in the past. So that's a possibility. The other possibility is quite a few central banks are buying gold. Just before the new year, the Financial Times ran a piece noting that central banks were accumulating gold at a rate not seen in 55 years, which is pretty tremendous, actually. In the third quarter of 2022, analysts estimate that almost 400 tons of gold were bought by central banks. That much gold would take around 16 semi-trailers trucks to transport. In November, traders in the gold market noted that there was a huge buyer entering the market and purchasing a very large volume of gold, a so-called whale. In December, it was revealed that this whale was the Chinese central bank, but it wasn't just the Chinese buying. Other buyers included Turkey, India, Uzbekistan, Egypt, Qatar, and Iraq. It is worth noting that many of these countries have expressed an interest in joining the BRICS alliance. So I think a lot of this has to do with, seeing what has happened to other countries, and specifically Russia recently. Why keep all of your assets in dollar-based, your foreign currency, your surpluses, whatever, what have you, in just US dollars? If you do something that the US doesn't like, the so-called rules-based order will take your money away from you, and you have no recourse. So it's just prudent, as it is prudent for the individual, to diversify. And gold's, it's easy to diversify, and you have storage risk, but that's not hard for a central bank or a government to store gold. They have vaults and they have guards with machine guns. It's not that hard. And the overall cost when you're talking about 400 tons of gold is not that much, with respect to storage costs. So it's easily you can sell gold anywhere in any country in the world. So it's a reserve asset, and it's not a liability. You don't have a counterparty. You have no counterparty risk. And so I think that's what makes it attractive. Do I think that, I'm not a gold bug, do I think that, these countries are going to back their currencies with gold? I don't think so. Governments like the flexibility of being able to print money out of nothing to do things that they want to do, that they find politically expedient. But I do think that, we're due for another gold bull market just because of what we're seeing. Again, I think, central bank and government, malfeasance. This is why you want to have insurance. This is why, Ray Dalio, Kyle Bass, other large investors keep, a certain amount of percentage of their assets, personal assets, in precious metal, physical precious metal, just as insurance against, as I've said before, central bank and government malfeasance. And so I don't, especially what's happened recently. I mean, the U.S. government has really made its position clear. You're either with us or against us. And if you fall in the disfavor, one of the tools we will use in our so-called rules-based order is to confiscate your assets, and you have no recourse. So it makes sense as insurance against that to diversify into something that they can't get their hands on. Indonesia tells tin industry to be prepared for an export ban. This is another theme that we have longer term, is resource nationalism. These emerging markets like Indonesia, for example, don't want to be, raw material colonies for more developed manufacturing places. So they're telling people, we have the materials that you need. These things are in shorter supply. And if you want them, you have to build processing plants here, or value added plants here. We're not just going to let you dig the ore up and then, take it away. And that's all the value chain that we capture. So they've done this already with nickel, I guess, for some success. And so they're considering it with Indonesia. So here's what the article says. Indonesian authorities are preparing data and assessing current industry conditions to be ready in the event that the government decides to bring in a ban on tin exports, a senior mining industry official said on Wednesday. The Southeast Asian country, which is the world's top tin exporter, has already moved to halt shipments of a number of other metals in order to develop more processing at home. That's more jobs and more value add for Indonesia. That was my own comment. Indonesia's nickel ore export ban has attracted massive investment into nickel plants, and the president of Indonesia had repeatedly said he wanted to replicate that policy for bauxite and tin. Bauxite, as you know, is the precursor for aluminum. So this makes sense. Governments should exist to do what's best for their citizens, and capturing more of the value of your raw materials instead of just being a raw material exporting colony for other countries isn't going to fly anymore. And so you're going to see more of this, not less of this. This is going to make things more expensive and take it longer to develop. I mean, if they shut down tin exports, then you have to go there and build tin processing facilities. That doesn't happen in a year, right? So, or a month. So you take a certain amount of supply of tin off the world market until that is done. Something similar which happened to nickel. So if you're Indonesian, you should applaud this. If you're a user of tin, you should be prepared to pay more for tin. And this is, I think, a trend that is not specific to Indonesia. You will see more of this as we go forward, not less of it. I wanted to point this out. Again, you see this. This is the S&P versus the TSX Venture. The reason I want to point this out, TSX Venture is the Toronto exchange, the venture exchange. Is where you have a lot of your junior mining, smaller oil and gas companies, things of this nature, more volatile, risky type companies that are predominantly resource extraction businesses. And what you've seen here is, again, we don't want to give too much attribution to the squiggly lines on the chart, but you see this move higher recently in the TSX Venture Exchange versus the S&P. When this is going down, the S&P is outperforming the mining stocks, the junior mining stocks on the TSX Venture. You see this little breakout here. You can barely see it. This chart's a little bit light. I think this is interesting. Again, that doesn't mean I'm bullish now, but it's another, are people positioning, do they see something getting ready to happen where commodities, resource type companies are going to outperform the S&P companies? I think this, we should watch this because this would be an interesting tell, right? This thing's really come down over 2022 as we had, an initial outperformance and then the fall off in the last 6 months. But now it looks like we may be, putting in a bottom and breaking higher. So something to keep in mind. This is an article that was on Zero Hedge, and it was a link to a paper written by this Dr. Wallace Mannheimer. And the title of the article on Zero Hedge was "Net Zero Will Lead to the End of Modern Civilization." Again, people ask, why are you bringing these things up on a financial channel? Well, this is actionable. This is part of the view that we have about the heads you win, tails you win more. The Western governments have decided that they're going to pursue this net zero policy. The global East and West, where the majority of the people live and the majority of the purchasing power is going to be over the next couple decades, they're giving lip service to this. So what does this really mean? Okay, when you say net zero, see these people, again, I follow the view that you should define your terms so that people actually know what you're talking about. If you stay ambiguous or you don't, I listen to this, for example, I don't like to pick on these people. This really shows my irritation. You had this ban, they want to ban now gas burning stoves, right? Because they supposedly cause all these health issues. And then you have this ridiculous AOC person made a TikTok video or something. I saw it on Twitter. Oh, yes, I have a gas stove, but I just rent my house, so it doesn't apply to me. I mean, just the preponderance of ignorance, hypocrisy, nonsense is you cannot have a modern civilization if this is what kind of people are in leadership positions making policy. And we have too much of this nonsense. This is why, I like to read these papers, because it tells you what's going to happen. I think one of the quotes in here is perfect because it goes back to what I've said before. I said this before and recommended books about this, about energy return on energy invested. when we were a basically animal and human labor based energy sources back in before the steam engine, and what life was like there. That's what this paper basically gets into, and how wonderful the discovery of these high density fuels like coal and petroleum have been to our life. And people take it for granted, and they shouldn't do that, because your life would be a lot different if it wasn't for coal, steam engine, internal combustion engines, and things of this nature. So anyways, here's a few, I suggest you read the paper. It's like 19 pages, I think, from this Wallace Mannheimer, but there's a couple quotes from the article I wanted to point out. In a recently published science paper, Dr. Wallace Mannheimer said it would be the end of modern civilization. He's talking about net zero. Writing about wind and solar power, he argued it would be especially tragic, quote, when not only will this new infrastructure fail, but will cost trillions, trash large portions of the environment, and be entirely unnecessary, unquote. The stakes, he added, are, quote, are enormous. Mannheimer points out that before fossil fuel became widely used, energy was provided by people and animals. That's exactly what we said. This had all kinds of detrimental effects to the way people lived their lives. Because so little energy was produced, basically 2 to 1 energy return on energy invested on animal and human power. Basically, you're relying on your crop yields to produce enough food for yourself and enough fodder for your animals so that you could make it to the next spring to plant again. That's why civilization didn't really take off. It was grinding higher very slowly, because there was no surplus of energy that could be used to better people's lives. You were basically at a subsistence level, scratching out a living like a hobbit. It says here, because so little energy was produced, quote, civilization was a thin veneer atop a vast mountain of human squalor and misery, a veneer maintained by such institutions as slavery, colonialism, and tyranny, unquote. Yes, I agree with that. That's exactly right. Because you didn't have huge surpluses of energy where you could be self-sufficient or invest in new technology and advanced civilization, you had to exploit other people, other countries. This is why you had wars and plunder and things like this. In Mannheimer's view, the partnership among self-interested businesses, grandstanding politicians, and alarmist campaigners, quote, truly is an unholy alliance, unquote. The climate industrial complex does not promote discussion on how to overcome this challenge in a way that will be best for everyone. Quote, we should not be surprised or impressed that those who stand to make a profit are among the loudest calling for politicians to act, unquote, he added. This is, again, human nature. This is Charlie Munger's advice. Show me the incentive and I'll tell you the outcome. Okay, when I first was involved in the renewable industry, it was small. It didn't have the constituency that it has now. It didn't have the level of, it was a bunch of hobbyists and first movers and guys in their garage building windmills. And then this thing got going, and then people latched onto it. Then you created these various lobbying groups, industry associations that are filled with lawyers and lobbyists that funnel money to politicians from the manufacturers and the developers that are part of these organizations. It's the same thing that goes on in pharma. It's the same thing that goes on in the defense industry, or any other area where there's money to be made or money to glom onto on the federal budget. You create these groups. Now you have an industry that's so large and employs so many people and has so much lobbying power that you have the entire media, scholastic, university systems, politicians, news media, everybody behind this, and so it has its own inertia. And so this is why it continues. This is why we're not policymakers here. We look at the policies in place. We look at what they're going to spend on it. It doesn't matter. They're not coming to us and asking us what we think. There's people way smarter than me, like Mark Mills and people like that constantly lecture on this, write papers on it. And I think the cracks are starting to form in the ESG narrative. But in the end, when there's hundreds of billions of dollars of potential cash sitting there, people are going to go, they're going to advocate to grab as much of that for themselves as they can. In the end, though, as we've done that and focused on these technologies that cannot, in his view, like he said before, this new infrastructure will fail but cost trillions. We have not taken those trillions and efficiently invested them into new oil and gas, coal, or nuclear. And then we are going to pay the price for that with, I believe, an energy crisis, which we're currently in, and is currently in hiatus in some places like Europe, but has not been solved. And I think you will see, again, I've said that we will see ultimately before the end of this crisis, what are we at, 5 or 6% now of energy being as a component of the S&P? There's no reason that by the end of this cycle, we can't end up at 20 to 25% of the S&P being energy like it was in the late 70s and early 80s when we had the last really major worldwide energy crisis. And I think people will be surprised. That will be the time, of course, to sell, and that's nowhere on the horizon over the next year or so. But I suspect by the end of the decade, people will be shocked about this. And I believe that you will actually see, because of the energy crisis that we will be in and continue, the public policymakers will be exchanged out for more rational ones. And you could even see a situation where instead of subsidies going to rebuildables and these nonsensical storages technologies and electric vehicles, where you see the reemergence, you actually see policymakers trying to incentivize fossil fuel and nuclear. So to a large extent. So that's my view. I think it's actionable. Again, our portfolio did very well last year. Obviously, it suffered. You're going to have volatility. It kind of made its high around June of last year. And then as oil and gas prices and other commodity prices slid, we pulled back. But we were still positive. We handily beat the S&P. So I think that we're on the right track here. Again, I suggest reading these things. I don't put these things here for confirmation bias. If somebody wants to propose, the other side of why oil and gas is going away, like these people that say peak demand, well, they don't take into account the emerging markets. These emerging markets require, especially you have these emerging middle classes, emerging demand for the things that you have, they want. And how do you get there without, more and more supply of fossil fuels? I just don't see it. So I don't see oil and gas demand topping out in the next, 3 years, like some folks are saying. It's people that are actually smart people. And so, I'm happy to have those arguments and somebody make the argument why, what I see is that the pressure that the political class and the media, especially in the West, are putting on a lot of these fossil fuel producers are simply not going to invest in the current climate. And that will affect supply, and that, the demand doesn't go away. Again, look to the east, look to the global east, the global south. That's where your demand's coming from. That's where the relentless urbanization, industrialization, people entering the middle class, that requires huge, tremendous amounts of energy inputs, and that simply will not be provided by solar panels in places like India. It's just not going to happen. And that's not how you're going to get higher wealth levels in those countries. Fossil fuels are integral to the and nuclear will become, because intermittent sources do not work in a 24/7 economy. It's just that simple. And again, getting this right is going to determine how well I think you do this decade in investing. If you get this wrong, if you don't understand what's going on and you're on the wrong side of this thing, I think that you're going to severely underperform. That would be my view. Okay, guys, that's it for this week. I believe this is the last slide. Yes, that's it for this week. Appreciate the support. Let's get over 10,000 subscribers. Again, if you're not a subscriber and you enjoy the channel, please subscribe. It helps the channel a lot. We want to hit 10,000. We get to 10,000, we'll have a live stream and invite people and have some celebration about that. But I want to get to that 10,000 level. It's kind of that number I've been slowly grinding towards, and we need your help. All right, guys, that's it for this week. We'll talk to you next week.